This episode is brought to you by Tegas, the only investing research platform built for the investor. With traditional research vendors, the diligence process is slow, fragmented, and expensive. That leaves investors competing on how well they can aggregate data, not on their unique ability to analyze insights and make great investment decisions. Tegas offers an end-to-end platform with all the data you need to get up to speed on a company or a market. Up-to-the-minute financials, customizable models, management and culture checks, and of course, our vast and growing library of expert call transcripts. Tegas is changing the world of expert research. Learn more and get your free trial at tegas.com/Patrick.
This is Business Breakdowns. Business Breakdowns is a series of conversations with investors and operators diving deep into a single business. For each business, we explore its history, its business model, its competitive advantages, and what makes it tick. We believe every business has lessons and secrets that investors and operators can learn from, and we are here to bring them to you. To find more episodes of Breakdowns, check out joincolossus.com.
All opinions expressed by hosts and podcast guests are solely their own opinions. Hosts, podcast guests, their employers, or affiliates may maintain positions in the securities discussed in this podcast. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.
This is Matt Reustle, and today we are breaking down D.R. Horton. Our guest is Ed Wachenheim, founder of Greenhaven Capital. Now, to bring you behind the curtain a bit here, when I heard Ed was in for a breakdown, I did my best to treat this professionally. But I will let it be known, I am a major fan of Ed. In 2016, Ed wrote a book, Common Stocks and Common Sense. And in the foreword to that book, Ed laid out his framework for how he approaches investing. Now, I'll spare you my reinterpretation of those words and just recommend the book to anyone or any investor that hasn't read it yet. But in the same way that Michael Mauboussin grounds you in the foundation of fundamental investing, Ed did this in his own form. And if you ever hear me on the show saying, average companies should trade at 15 or 16 times, Ed really laid out the reasoning for that in his book. And if I had any concern that Ed would live up to my high expectations, that was quickly squashed. What you will hear is an incredible discussion walking through D.R. Horton and the homebuilders broadly, and just how much has changed with this business model over the years. Ed's stories with the management teams are enough to fill an episode and entertain you. But to my extreme joy, anytime I would ask Ed to quantify a point, he had the number handy. And he brought a lot of those numbers proactively into the discussion. So it's an excellent conversation, an excellent glimpse at how someone like Ed approaches his investments. And without further ado, please enjoy this breakdown of D.R. Horton. All right, Ed, I am excited to have you here to talk about homebuilders, D.R. Horton, and I was thinking about where we start, and I thought it would be silly not to capture some of your experience looking at this sector over time. And in preparation of the discussion, it was mentioned that you've been looking at this space since the 80s, which I think is incredibly unique. And I thought maybe we could go into the Wayback Machine and talk about what it was like looking at home builders in the 80s, and we can just evolve over time because I think a big piece of this is the evolution of the business model. But maybe you can bring us back to the 80s and what it was like to be looking at these stocks at that period of time.
Great, Matt. And you've just given away my age a little bit, but it's great to be here and speaking to you. Yes, it goes back to the 1980s. I was on the board of a company called Interstate Brands, located in Kansas City. The CEO of Pulte, which is now the third largest home builder, was on the board also. And between committee meetings and the board meeting, I used him as my professor. I called him Professor Jim. It was Jim Grossfeld. And I said, Jim, would you teach me something about the home building business? And I bought some beers and I bought him some coffee, and I got a good understanding, I think, of the fundamentals of the industry at the time from the professor, which I owe a lot to.
I'm sure. And were you an active investor in the space in that decade, in the 90s? Was that something that you were frequently invested in?
Good question. No, it was a tiny industry at the time, probably not investable in terms of the size of the companies. But in the mid-1990s, I was screening for stocks, I think on the Bloomberg, looking for stocks that were selling at low P ratios, low prices to book. And I came across a company called U.S. Home. And it was selling at about 0.6 times hard book value and less than 6 times earnings. And those ratios, of course, are adrenaline flows for value investors. So I did some work on the company, and we ended up buying the stock. And then over the subsequent years, in the late 1990s, I noticed that it and the other public home builders were growing considerably faster than the economy and then the home building industry in general. And I tried to figure out what was going on. And what was going on was that many of the very small home builders couldn't compete any longer, either because they did not have scale, but particularly during that period of time, there was the thrift crisis, the savings bank crisis. Many of the very small home builders were dependent on the thrifts for financing. And as the thrifts went out of business, the very small home builders found difficulty finding financing, and they were going out of business. So the larger companies, particularly those that were public, that had availability of financing, were growing at the expense of the very small home builders. So it was a consolidating industry. And in fact, the large home builders were growing very rapidly. And that was a great opportunity to, I thought, make a considerable amount of money on the home builders. So we bought the home builders very heavily in the year 2000, and they did very well. And the stocks went up several fold. They reached the point at about 2005 where their risk-reward ratios were no longer attractive to us, and we sold them. And then we bought them back in about 2014 and have held them ever since. That's our history.
It's quite some discipline to be on the sidelines for that 9-year period. Can you talk a little bit about the 90s and early 2000s? You mentioned the consolidation of the industry, fragmentation. I gathered from the basic research that I was doing that there were some pretty material tailwinds just in terms of build out. And obviously, some dynamics of that played into what happened in the financial crisis. But just from a business model perspective in that time frame versus what you're looking at today, and I think this will shape a lot of the conversation. But can you talk about the business model then and what maybe the main characteristics are that would look different than what it looks like today?
The business today is completely different. The business model is completely different. At that time, there were thousands and thousands of builders in the country. The largest builder, I think, was Centex at the time, and they had about a 1% market share. And the second or third largest builder and the fourth largest builder were a fraction of 1%. So what a builder would do would be to go out and buy some land, get the land permitted, get the land developed, and then build some model homes on the land. And then using the model homes as a selling tool, then would go out and try and sell homes, would get a deposit, build a home, and when the home was completed, then the home would be sold. In effect, money would change hands. The builders would then tend to take the proceeds from the sales and go out and try and buy more land. So it was a land-intensive business. Sell a house, go out, buy more land. And as a result, these companies continually had leveraged balance sheets because they had a considerable amount of land on the balance sheets, to the effect that in some cases they had to go out and not buy the land directly, but option the land. So optioning of the land, which is now prevalent, at that time was a necessity, not a choice. So if you look at the industry at that time, many players tended to have ROEs below 10%. Because they had large investments in land. When you think about it, a land is not a good investment. Land might appreciate in value 3 or 4% per year. The home builders need to keep 5 or 6 or 7 years of land supply relative to the number of houses they're selling in order to have an adequate supply to have time to get the land permitted and developed and then ready to build on. So they had these large investments in land. They were real estate companies that happened to build houses. And that's the way it looked. Their cash flows mainly went to buy more land and were not available for the shareholders. So it was not a good business. We called them stick builders, which is not a favorable name. And they probably deserved to sell at low multiples. I mean, highly leveraged with debt, low ROEs, and not very good cash flows. The turnaround was, and the optimistic side was, they were growing rapidly. So they were good investments because their earnings per share were growing double digits at the time because of the gains in market share.
It's interesting. The way that you describe that brings me very much to the oil and gas world of leasing land, producing wells, mostly taking the cash that comes out of those wells and then plowing it back into more wells. And it's a model that theoretically works as if the demand for your output is growing, in which case housing and the market in the late 90s and early 2000s was incredibly strong. But when that demand dries up and you have land exposure, levered balance sheets, I can understand the challenges and what happened there. And I think that's a fairly well-told story. Putting a bow on this piece of it, in that era, how long did it take from that initial purchase of the land till you were actually seeing sales? You mentioned the permitting process, and then there's the building process, and then there's the marketing the model homes. What did that look like in terms of dollars being outlaid and then dollars coming back in? Was there a conversion cycle in terms of years that it took to see that cash come back?
So the best way to look at it, if you go back to Horton, for example, 10 years ago, 2013, for every dollar of sales, they had more than $1 invested in inventory. That inventory could be divided into houses under construction and land. And close to 2/3 of that would be land. So they had a very large percentage of their invested capital tied up in land. Now, we started thinking, and occasionally we get proactive, not against managements, but in terms of ideas. And as early as 2005, I was in a meeting with Centex. Tim Eller was the CEO of Centex. And I brought Jim Grossfeld, my professor, in on the meeting. And we started talking about the nature of the business. My argument and Jim Grossfeld's argument was, why do you need all this land on the books? Why don't you option the land? You're optioning some already. Make this an asset-light business. Take down the land just before you need it, and it'll completely change the nature of the business. One, much less capital intensive. Therefore, a large percentage of the earnings will come to the shareholder in terms of free cash flow. You will not need much debt on the balance sheet. Your ROEs will increase dramatically because building homes was a good business, but owning land, 5 years supply of land, when land appreciated 3 or 4% and you had to finance that land, was a bad business. And Tim Eller fought us. You don't understand the business. We've been very successful. Don't criticize us. We had a little of an argument, which I actually wrote about in the book you referred to that I wrote in 2016. But what happened was there was one home builder, NVR, that always was land light, had an excellent balance sheet, high ROEs, bought back stock, and typically sold at 16 times earnings. As a matter of fact, the average PE ratio of NVR from 2015 to 2019, we go to the pre-COVID period because it was a more normal period, was 16 times earnings. In the meanwhile, Horton was selling at 12 times earnings. So the NVR model was a much, much better model. And what has happened is, and frankly, we were a little proactive in speaking to the managements to do this. The managements have, I would say, gotten religion, and they have gone to the asset light, don't own a lot of land model. So Horton today, their option land is 75% of the total land they control. And it was about the opposite of that. It was 25% if you go back 10 years ago. And that has completely changed the balance sheet. If you go back 10 years ago to 2013, they had $2.3 billion of net debt in their home building business. Today, I will say that was September 30th, which was today because that's the end of that fiscal year. They had $600 million more cash than debt in the home building business. Completely different business. If you go back 10 years ago, their ROE was about 10%. Last year it was 22%. So the business has transitioned really from being a real estate business to being a manufacturing business. Horton today is a high-volume manufacturer of homes. It's a completely different business than it was in the 1990s.
You mentioned NVR, and I would be remiss not to bring up one of the better or most known stock pitches ever that sits on Value Investors Club in 2001-ish range, talks about NVR and how their model is different. And it's a great place in time write-up because you know what ended up happening there. You mentioned a little bit of the pushback that you got on why they didn't have the model, which didn't seem to carry much logic. It was just simply, you don't know how we operate, and we've had success over periods of time. Were there any good reasons to not move towards the optioning of the land and continuing to be landowners. Before we move on to Horton specifically, was there any good reason to consistently own the land rather than have an option on the land?
No, it was a mental attitude. It started when builders were very, very small builders, and they simply went out and said they had friends with a local banker. Okay, fine. I see this plot of land coming up. Will you finance it for me? Yes. Okay, fine. They buy the land. And of course, because of their size, they had not developed the relationships with land banks and land developers that the larger companies like NVR developed. So it was partially size and it was just partially a metal set. I had many conversations with Bob Toll, who was the founder of Toll Brothers, along with his brother. And he had a mindset. Don't bother me with this. I just want to buy the land and own it. We'll do fine. That was the attitude. It was only after he passed away that Doug, who's the new CEO, completely changed the model. And now they are becoming asset light. It really is the way to go. And manufacturing homes in a consolidating industry is turned out to be a very good business for the very largest players who have scale. And the scale advantage is huge that Horton has and Lennar has. And they're continuing to gain market share, as you know.
Yeah, it's a good opportunity to transition to Horton. The largest home builder is how it's marketed in the U.S. But maybe you can just introduce us to the name in terms of what you would describe as differentiating about D.R. Horton as a home builder relative to any others. Maybe size is the main factor, but just the brief description on who D.R. Horton is.
Sure. And let me go back to the beginning. There is a man, D.R. Horton, Don Horton, still alive. It came from a small town in Arkansas. His father was in the real estate business and raised cattle. It was a real rural town. And Don went to the University of Oklahoma, got married while he was in school, dropped out to support his wife, worked for his father for a while, was more ambitious than the opportunities in a small town in Arkansas would present. So he moved to Fort Worth and worked for a home builder there. And then after working for the home builder about 1 year, decided to start building his houses himself. He had $3,000 of personal net worth. He went to a banker and borrowed $30,000. The banker had faith in Don Horton, and Don built his first house in 1978. Successful. 1979, he built 20 houses. In 1980, he built 40 houses. And the company went public in 1992 at a time when they built 1,200 houses. So that's an example. 1,200 houses with 0.2% market share. They operated in a limited number of markets. The years went on. Horton grew by increasing their market share in existing markets and also by diversifying into other markets. Today, they're in 118 markets. A market might be Jacksonville, or it might be Atlanta, or it might be Orlando, and they're in 33 states. They grew partially through acquisition, but when they acquire companies, they're usually acquiring companies in trouble because of financing that own land. And what they're really acquiring is the land. So the beauty of this industry, it is a rolling up industry. It still is rolling up. The companies are still gaining market share, but they're doing so through acquiring land at book value as opposed to acquiring other companies and paying a large premium. So if you look at the home builders in Horton, they have almost no goodwill on the balance sheets. Lennar is the exception. They bought a company called Catalanic, so they have $3 billion of goodwill on the balance sheet. Still a very strong balance sheet. Horton has virtually no goodwill on the balance sheet. Don Horton was very good. And I think one of the correlations is a correlation between the size of the company and the quality of management. It's almost Darwinism. The best managements were the ones that grew, of the thousands and thousands of home builders there were, and Horton today became large because of good management. They do have a niche as such. Their niche is the first-time buyer. So they tend to buy land in more outlying areas where land is cheaper and build less expensive houses. Their average house sells for about $375,000. Lennar is the second biggest home builder. Their houses are more like $450,000. Pulte, the third largest, is about $550,000. So they're at the lower end. They also, for manufacturing efficiency, tend to build houses on what's called spec, which means they will build a house, will start a foundation. Then as the foundation is complete, they will start the next step, which is usually putting up the timber, the wood, the frame. And at the same time they're doing that, they might start the next house, the next house, the next house, the next house. Most of these houses are sold before they're completed. If the houses are not sold before they're completed, if they're building more houses than they're selling, they'll slow down the process. If they're selling more houses than they're building, they'll speed up the process. But the beauty of this, and one reason why scale really matters, is that they can hire a subcontractor. So they hire the plumbers and the masons and the framers and the roofers. These subcontractors can go from house to house to house to house and not have any downtime with their employees. It is highly efficient for the subcontractors, which means that Horton can build houses in this manufacturing, almost assembly line process, cheaper than smaller companies. And what's happened in the industry is the large companies have major advantages in costs over the smaller companies. And they continue to gain scale for that reason. They continue to gain market share.
I'm sure it's difficult to put a number on that, but if you had to guesstimate what that cost advantage would be on a $350,000 house, do you have any sense of what percentage cost savings they might get relative to the mom and pop home builder?
I actually do.
Oh, perfect.
Horton and Lennar, over the last 5 years, had average operating margins of 16%. They are the two largest. If you go to mid-sized builders, which are not small, that have 12 or 13 or 14,000 homes per year sold, Horton has, it could be 90,000 this year to get an idea of the difference. But if you go to the mid-sized ones, their operating margins are about 12% in the last 5 years. That's Taylor Morrison, for example. It's KB Homes, and it's Meritage, those three. So they average about 4% less. And those are still pretty sizable companies. They're large companies by some standards. If you start getting into the companies that build 1,000 or 2,000 houses a year, the margins probably are well below 10%. And then you get to the question, are the returns, particularly after interest expense, worth it? Can they make money at that? I have spoken to a number of small builders, and of course the returns for the very small builders vary tremendously. You've got some very scrappy small builders that do well, but many small builders really struggle. When they're struggling and not earning good returns and have the risk of debt because they cannot option land when they're small, they don't have the wherewithal to do so, many of them are simply saying, I no longer need to be in business, and we'll either build out the land we have and disappear, or I will sell the land to a Horton or a Lennar.
And with the industry development, you mentioned Horton has this niche at the first-time home builder. If I were to guess how the market was going to evolve, I would have expected maybe there was more of a geographical focus rather than a demographic focus or a specific place in the market. How did that evolve over time? Was there ever geographical concentration for the home builders? Has that completely gone away? Is that still a dynamic in the market?
There's a huge geographical concentration. If you look at the Northeast, there are not many new homes built, particularly in communities. It's sort of one by one by one. If you look at the upper Midwest, there are not many new homes built. We used to call it the smile. It really starts in, say, Maryland, goes down the East Coast, down to Florida, which is a very big state. Alabama is a big state. Louisiana. Texas is huge. And then Arizona, Nevada, those states, New Mexico, and Idaho are really growing. It used to be California very heavily. It still is California because of the size of the state. But California slipped because of tax issues and economic issues. And it used to be more Oregon and Washington, and they've slipped a little bit. But it very much is the Southeast and Texas. And then I would say Arizona and New Mexico are really hot right now. So there is a very heavy geographic concentration for the home builders. There's no question about it.
When you think about the geographic dynamics, I think in the 2007 to 2010 timeframe, a lot of the overbuilding or the most stress was felt in those sand states that you mentioned, and that was a category. How do you frame that in terms of whether it's a risk or whether it's an opportunity to see that geographical concentration? Is that something that you consider to be a risk or maybe a secular tailwind? Just how do you put that in terms of framing into the investment thesis?
Every situation is unique, and you have a unique situation now, and you had a unique situation in the year 2005, 6, 7, and 8. The situation then was you had high interest rates in the 1980s and 1990s. After 9/11, interest rates came down, and you had a little bit of recession in the year 2000 also. So houses were more affordable, and you started to get an increased number of individuals wanting to buy a new house. One of the characteristics of the home building industry is you cannot increase production very quickly. So demand exceeded supply, and the prices of houses rose very sharply at that period of time. People were even camping out to get online to buy a house. Individuals, in retrospect, were the prime cause of the housing crisis because they paid much more for houses than they were sold at 3 or 4 years before and much more than they were worth. And then what happened was the value of houses came back down to normal. A lot of mortgages, therefore, were underwater. That was a unique situation. It's a good prelude into what happened today. After that, mortgages were difficult to get. And for some reason, people were getting married and having children at an older age. There was a big transition during that period of time. The prime time in life to buy a house as opposed to living in an apartment is when you get married and have a child. So for those two reasons, the demand for houses was relatively soft from 2007 really until very recently. And as a result of that, the nation became underbuilt. We have a basic demand in the United States for about 1.5 million new housing units per year. And you can divide that into two parts. About 1.1 million is just population growth. So to put that in perspective, there's 145 million housing units in existence, and the increase in demand is about 1.1 million a year, or about 0.7%, and that's population growth, basically. So you've got that growth, and then about 400,000 houses a year are torn down, either because of age, because of fire, because of flood, because people just don't like the design and like the property, and they want to tear down the house and build a new house on the property. So there's a basic need of about 1.5 million a year. We substantially underbuilt for about 12 years. And as a result of that, there's a shortage of estimated between 3 and 4 million housing units in the United States. And the situation today, which is very different than the situation then, is there simply is not, in our opinion, the capacity to build much more than 1.5 million housing units. Maybe you can get to 1.6, maybe you can get to 1.7. But there's a shortage of labor. There's a shortage of some materials, and it's very difficult to get land permitted and developed at the current time. There's just not the resources in this country. Now, maybe over a 5 or 10 year period of time, more resources will be available. But just for example, right now, it's hard to get transformers. So you can't sell a house and you can't build a development unless you can get transformers. So in home building, if there's one material or one part of the labor or one part of the process of getting land developed that you can't do, you can't build a house. The way we see things, we think that the number of housing starts, and that's complete units, including apartments, can go back to maybe 1.6, 1.7 million per year, but can't get much higher. Since the shortage is 3 or 4 million housing units in the United States, and the normal demand is 1.5, if you could get to 1.7, you'd be reducing the shortage by 200,000 a year. It would take 20 years to eliminate the shortage. So this is a very different and optimistic scenario for the home builders. They really have a long runway ahead of them where demand should exceed supply. And an important consideration is, yes, the home building industry is cyclical, but people have to live somewhere. And if you're married and you have a child, you don't want to live with your mother-in-law. At least I don't want to live with my mother-in-law. And you probably don't either, Matt. So there is this basic demand of 1.5 million a year. It could be a little more some years, it could be a little less some years, but this is a unique feature about the home building industry. You've got a firm demand. And because we are so underbuilt, the home builders should do very well over the next 5 or 10 years. And it is cyclical, but one has to be very much less concerned about a down cycle of any long period of time. Yes, interest rates could spike to 10%. And for a while, it could be sticker shock. But eventually, somebody still has to own a house. And if you go back actually to the 1980s and 1990s, believe it or not, mortgage rates averaged 10%. About 1.3 million housing units were built per year on average during that period of time. And the population of the United States at that time was 250 million. If you adjust the population of the United States to the 330 million today, That's equivalent of a demand of 1.8 million housing units per year with 10% mortgage rates. So you can see the basic demand is there and was there during a 20-year period of time of high mortgage rates and lack of affordability. So, yes, you could get sticker shock. Yes, you could get a recession. And there might be a short period of time when housing turns down. It is cyclical, but the long term looks very, very positive. And the large home builders not only have the tailwind of strong demand, but they continue to gain market share. So this becomes a growth industry.
Very interesting thesis just laid out right there, and a lot of different angles that I want to cover. For someone like D.R. Horton, when you have this type of environment where there's a shortage of supply and there is still strong demand and a need for housing, do they benefit from what would basic economics would say, strong demand, capped supply, pricing would go up? Are they beneficiaries of pricing going up in the financial model of D.R. Horton? Do they capture a lot of that economic benefit?
Pricing has gone up a lot. There were supply constraints in 2021. And in 2022, prices went up quite a bit. And interest rates are up. So affordability is an issue. And that limits, I think, the amount of price increases they can get going forward. But I don't think we need them. I think if prices stay where they are for the next couple of years, and then probably prices will increase with inflation as they have in the past. 2% per year, 3% per year, 4% per year. But we're not counting on that in our models for the next several years.
And you did mention before there's challenges with labor and just general supplies. They're beneficiaries relative to the rest of the market, given their size. So there's economies of scale. But do they get squeezed on the margin side if you have pressures on the cost side of the equation, but maybe an inability to pass through on price? What has that looked like, maybe the 2020 through today timeframe in terms of the margin profile of the business on those homes?
They, I think, will be able to maintain their margins. Not increase their margins, but maintain their margins. And that's our premise. Costs are going up, but they are getting some price release. Put it this way. There was a test. The test was last year. Mortgage rates about 2 years ago were about 3%. They went as high as 8% after prices of houses increased substantially. And there was sticker shock. Demand for houses temporarily went down sharply. The home building industry did very well. They held their margins. And yes, they sold fewer houses in 23 than they did in 21, 22. But their earnings were very strong. They were put to the test and they passed the test. If you speak to the companies, they are getting increased efficiencies and they are being able to offset a lot of the costs. The biggest cost concern would be land. I think in terms of materials, material prices had gone up very sharply in 21 when there were shortages. And material costs, if anything, are coming down a little bit. If you look at labor, there was a shortage of labor in 21, 22. And contractors were charging more than they had been. And labor costs have stabilized. Land costs are still going up. Raw land is about 10% of the price of a house in costs. And developed land is about 20%. You buy land for 10% and then you spend another 10% of the price of the house developing the land. So that 20% of the cost of the land is still going up, but they're offsetting it heavily through efficiencies. The big companies are getting better and better and better at manufacturing homes. It's just mass production.
I think you mentioned it before, but can you remind me that normalized margin that you would assume for this business going forward?
It's about 16%, which was the average of Lennar and Horton for the past 5 years. And if you break it down a little more, I think the gross margins for Horton should be about 23.5%. I think they'll be about that this year. This is higher than they were 10 years ago, but they are benefiting tremendously from efficiencies of scale. They can buy their land better. They are able to offer advantages to their subcontractors, so the subcontractors can pass some of that on to them. When they go to buy materials, they're buying in large quantities. Horton buys its appliances from Whirlpool. They're now buying 90,000 dishwashers a year. They used to buy 30 or 40,000. They're getting a better price. So I think a lot of the gains of gross margins are permanent and they may even go up from here. So I would look at gross margins staying around 23.5. If you go back pre-COVID, they were about 21%. So they've gone and increased about 2.5%, and that is largely scale. It's some efficiencies. They're just doing things better. When you look at SG&A, which for Horton should be about 7%, it may be a little higher than that this year because they're growing rapidly. It used to be 9%, and that simply is scale. They used to build 40,000 houses. They now build 90,000 houses. They obviously don't need more than twice. They don't need twice as many employees, et cetera. That is pretty permanent. So I look at it that their margins should be 23.5%, less 7% SG&A, and maybe a little over 16%. And we don't increase that. They may get lucky because of a power in certain markets, get certain advantages and increase their margins from here. But we're not building that in any of our models. We're sticking to about a little over 16%.
From a top-line perspective, there's going to be cycles, but you mentioned this longer-term tailwind in the market. How do you frame the revenue opportunity or revenue growth over a normalized period?
So Horton says for the foreseeable future, they'll be able to grow close to 10% per year in units. And if you look at it, a large percentage of that, not all, because I think the housing industry is not returned to normal yet. We're operating in terms of single-family homes being sold, not the 1.5 million, but just single-family homes being sold was about 660,000 last year. And we think normal is about 825,000. It should get back at least to normal, and if the capacity is there, maybe something above normal. But if you look at market shares, and you go back to 2013, Horton was building 5.6% of those single-family sales. If you go back to 2018, it went to 8.4%. And if you go to 2023, it was 12.5%. So they have more than doubled their market share in 10 years. And there's no sign that that is being diminished. I would say that small builders today have had problems getting supplies, including labor. If there's shortages, the large home builders are going to get the refrigerators, they're going to get the transformers, they're going to get the contractors. And with the regional banks pulling back, many of the very small builders have been dependent on the regional banks for financing. And that financing is becoming more restrictive. So I think you're seeing, if anything, an acceleration of problems for the very small builders. And I think the market share gains will continue. So Horton looks in terms of units at something close to 10% per year. We use 8% in our model, not including any price increases for the next several years in our model, but it then should go up to 2 or 3 or 4%. And that would take growth, everything else being equal, up to 10, 11, 12% or something like that. In addition to that, they are generating large amounts of excess cash and they're buying back stock. Now, Don Horton is more conservative, and I have this argument with him, than I am. Right now, he has more cash than debt on the balance sheet for their home building operations. They have a few other operations. They will keep building cash to the point, I don't know what. They probably are buying back 2 to 3% of their shares each year. They should be buying back more. But if you take, and I'll be conservative here, 8% unit growth for the next several years, no price appreciation, so top-line growth of 8%, 2 to 3% share repurchases, you get something like 10, 11% gains in earnings per share per year. They earned $13.82 last year, and 10% gains would take you to $18 per share in 2026. We look at 2 years, so we're looking at 2026 at this point, plus the fact that they are building a balance sheet that's going to have too much cash on it. Incidentally, Don Horton keeps on his desk a model of NVR as a company and the price of their shares and the PE ratios. Because you have a situation, and this really is the bottom line to the home builders. You've got a situation today where Horton is probably going to earn about $14.50 this year versus the $13.82 last year. And the stock is selling at 10 times earnings. So NVR is selling at 16 times earnings. NVR is an excellent company. Horton is probably equally or more excellent because they are much larger, have efficiency of scale, and geographical reach. NVR is heavily concentrated in the Washington, D.C. area. I think the opportunities for growth for Horton are much greater. And if you look at market share, I mentioned between 2013 and 2023, Horton's market share went from 5.6% of houses being sold to 12.5%. During that same period of time, NVR's market share only increased from 2.8% to 3.1%. They grow much slower. They just are not expanding geographically. So it's an excellent company. But my argument is, if NVR sells at 16 times earnings, Horton and Lennar being the two largest home builders, being superbly positioned, should sell at 16 times earnings. And let me look at it another way. Over the last 50 years, the stock market has sold at an average of 16 times earnings. It sells at more than that today. The question is Horton, in terms of its growth, in terms of its management, in terms of its strength, an average company or, in my opinion, a better than average company? It's got higher than earnings growth potential than the average Standard & Poor's 500 stock. It's got a pristine balance sheet with more cash than debt. It's got a very large free cash flow, cash that I don't even know what they're going to do with the cash. And in addition to that, by definition, almost the management is excellent, because if the management wasn't excellent, Horton wouldn't have become the company it was today. On a qualitative and quantitative sense, it deserves to sell at more than 16 times earnings. And that is our case. If you look out just to see how much money you can make, our projection for 2026 is $18 a share, which is 10% growth. And again, that could be conservative. If the stock sold at 16 times earnings, it's $288 stock. Stock's $145 today, and you get a $1.20 dividend. So you come close to doubling your money. And if the stock happened to sell at 20 times earnings, it's a $360 stock. It becomes really a home run investment.
Exactly what I loved about your book was how simply you laid out the thesis relative to the market, average companies above average companies, with all the numbers to back it up. I want to get into that valuation gap. But one last piece on the income statement, because I want to transition a little bit to cash flows in the balance sheet. For revenue growth, what you mentioned before was when they're making acquisitions, it's typically land. So am I right to think that all of that revenue growth is generally coming from their own production? Maybe it's land that they purchased years ago, but it's not like they're buying companies. There's not much inorganic M&A growth assumed in that number. Is that the right takeaway?
That's exactly correct. If you look at the number of acquisitions they've made over the last several years, they've been very few and tiny, so tiny that most of them aren't even disclosed. It really is land acquisition. There's some person out there that's been building houses for the last 15 years and has 40 acres outside Jacksonville. It's an individual. It's Matt and company. They go to Matt, and Matt says, I'm getting old and I don't want to take the risk of borrowing this money. And they say, I'll buy the land from you. I'll buy Matt and company land. And they buy it. And it never even shows up in a 10K statement. That's typically what's going on. The companies are saying we have no need to buy anybody who is large at all. We will continue to buy land via buying small companies. And there's an accelerated opportunity to do that today because of the difficulty of getting supplies and labor, and particularly because of the financial situation with regional banks. So you may see some accelerated growth from Horton and Lennar, and maybe that is why they're keeping so much cash on the balance sheet, just because if they see land opportunities, and they've mentioned that to me. But I'm still critical of their balance sheets. They're too strong. Incidentally, I'm a very conservative person, and usually when I criticize managements, it's for having too much debt. We just sold the shares of Whirlpool about a year ago because they made an acquisition and put too much debt on the balance sheet. So it's ironical that I am here speaking to Don Horton and saying, or to Stuart Miller at Lennar and saying, why do you have so much cash on the balance sheet?
The siren goes off in your head when you find yourself on the other side of an argument that you typically having. I want to get into the valuation gap. My initial instinct from hearing something like that is there must be a difference in the quality of earnings, NVR versus D.R. Horton and Lennar. And certainly that was potentially the case 10, 15 years ago. But as these business models have changed, the earnings conversion from those earnings per share into actual free cash flow, is there a substantial difference in terms of earnings conversion at D.R. Horton versus at NVR today?
NVR has been a master at developing land development companies that will develop the land for them and sell it to them exactly at the last minute before they're going to build a house.
Do they own those companies?
No, they don't. They just work out relationships with land developers. And there are contractors. If you're going to build an apartment complex, you're hiring somebody to build the road and build the electrical infrastructure and the plumbing, et cetera, that goes in before the apartment house is built. So they have developed those relationships over a very long period of time. They have developed them in this geographical area. They don't have them in other areas, which if they did expand, would be a disadvantage. So NVR probably is, let me put it on a scale from 1 to 10. 10 is asset heavy. 1 is asset light. So it used to be that Horton was maybe 7 or 8 or 9, relatively asset heavy. Today, Horton is 2, maybe 3, getting to 2 or maybe getting to 1.5. NVR is 1. So NVR is asset lighter. So they do generate more cash, and they use that cash flow to repurchase shares, but they don't grow as quickly. So they're offset. And I would call it even. I wouldn't say NVR's model is better than Horton's. I wouldn't say Horton's model is better than NVR. Horton definitely is more of a growth model, and they're going to increasingly get efficiencies of scale compared to NVR. The bigger you become, the easier it is to get land, the easier it is to get contractors, the easier it is to get materials, because if I'm selling doors and there's a shortage of doors, I'm going to sell to Horton before I sell to somebody who's building 25 or 30 houses a year. I've got to take care of my very, very large customers. It's not quite apples and apples. It's maybe apples and pears.
No, it's a very fair counter, and not that you're suggesting negativity about NVR's model, but at least pointing out the land development company relationships and that there is a cap to where they have those relationships and the geographical exposure. It's not a point that I had previously heard, and it actually does, I think, highlight some of the benefits that D.R. Horton would have just in terms of how they're operating. When you previously mentioned that shift in mix where I think 25% of land was optioned, and today it looks more like 75%. Is that the mix that you expect to be stable going forward?
The percentage of land optioned has continued to increase over the years. I think when you get to 75%, it might go to 80%. I think for Horton, they want to have the land under their control, owned, before they start building the models, developing it with houses. So I think that they will always want to own some land. And there are certain areas of the country and maybe certain pieces of land where it's just better to own than to option, financially or otherwise. So I don't think they'll get to 95%. I think that they may get to 80 or 85% over a period of time. But their model already is so good. I mean, they had a 22% return on tangible book value last year and 16% margins, and generated large amounts of cash flow and have excess cash. So you don't need to change the model at this point. You've got an excellent business currently.
I should have done this earlier in the conversation, but just from the optioning of land versus the outright purchasing of land, the difference in terms of what that cost is to actually option the land, obviously the big cash outlay would come at the purchase time, but do you have a rough sense of what the expense is to option land?
Yeah, I do. And the rule of thumb is it reduces gross margins by about 3%, the cost. And you can figure it out. They're paying the land bank about 11% interest rate, and they do it for a certain amount of time, and the land is 10% of the cost of a house, the price of a house, and developed land is 20%, so you can figure out. They get virtually all of that back in lower interest expense. So for the home builders, when you look at gross margins, it is after interest charged to construction, in effect. So now that Horton, instead of having $3 billion of debt when they were much smaller, has virtually no debt and is getting interest income, their interest charge of construction has gone down by more than 2% of the price of a house. So they have offset virtually all of the extra cost of optioning land. And of course, they have substantially reduced risk, because if anything happened to the industry, or if they had a piece of land that was really great, they thought, but then it didn't turn out to be so good before they bought it, they could not exercise the option. Now, that doesn't happen very often, but it is an advantage that reduces risk.
Hedging in some ways.
It is a hedge, and the hedges cost money.
And bringing the other potential hedge into the equation is that you mentioned they still build a lot on spec. What type of risk does that bring into their business model? Is that different than what you see with a lot of the other home builders? And are there any themes or trends which would make building on spec more or less attractive?
I think the old model was, Matt, you want to buy a house, come see the model. Okay, I need a 10% deposit. I'll build a house for you, and it'll be ready in 9 months. And that model has become less attractive to the buyer because most people don't want to wait 9 months. and less attractive to the builder because it's a one-off type situation and they can't get the efficiencies of scale. So the spec model, I think, is increasing in popularity. It's almost 100% of what Horton does. And the other builders from Lennar and Toll are going increasingly to spec. Now, the risk would be if they didn't have a good handle on demand and they were putting more foundations in the ground, more frames up than demand. But that really doesn't happen. They are starting houses and building them up. And normally the house is sold well before it is complete, in many cases before it's even framed or the wallboard goes in. If demand happened to turn down, or if they're just building too quickly in any particular community, the weather's bad or something, they start slowing the process down, and vice versa. So they have become pretty good at pacing the spec starts to demand. And it's somewhat seasonal. You start fewer during the winter because demand is slower during the winter. In the housing industry, you have the spring selling season, which supposedly starts at Super Bowl weekend. But of course, Super Bowl weekend was a week later. So I kidded them. Does this mean spring season is going to start a week later? They say no, it's going to start in early February. But early February, demand starts to go up because people start to look at houses heavily because they want to be in a school district in September and they want to get into the house delivered in time for the school year for their child. In some cases, in times for the summer because they have a backyard with a little bit of a wading pool in it for their children. So you get the spring selling season, and then they accelerate the number of specs during the season. The home builders are pretty good at this.
I was going to say that time frame, that accelerating in February for a September, the family has moved into the house. I mean, that's an incredibly short period of time, which I would have expected it to be much longer cycle in terms of the build out. But is this, to your point, the manufacturing process, which has just gotten that much better?
Yeah. Horton now, and I say now that supply constraints no longer exist, can build a house in very close to 4 months, a little bit more than 4 months from the time they lay the foundation to the house is complete. Now, they got to have an inspection, and there's usually a punch list, and then they've got to close the house. So typically, I would say from the time they break ground on the foundation until the time is actually sold and they get the money might be 6 months. So February to September, it works out that way. Now, the advantage is they do have some houses that probably have the wallboard in, and maybe they're starting to put in the flooring or the carpeting. And those houses, you might be able to get delivery on in a month or two.
Impressive. Tying the bow on cash flow dynamics and specifically capital allocation, you mentioned the repurchasing of shares, which could potentially go up in terms of using today's price and what percentage they're buying back. Is there anything else unique going on with capital allocation dynamics that you think is important to mention here?
No, you can pretty well figure out what the free cash flow is of a builder. Horton today needs about 50 cents of inventory for every dollar of revenues. That's about half of what they needed 10 years ago. So if they're growing at a certain rate, you can take the growth in revenues, you can divide that in half, and you can see how much more inventories they need. You can subtract that from net income, and you can see what the free cash flow is. So the free cash flow this year should be something over $3 billion. They say it's going to be over $3 billion. And to show the conservatism here, they say they're going to repurchase $1.5 billion worth of stock. Now, I think they're going to repurchase more than that. And it's a September year. In their December quarter, they did repurchase more than that going rate. And they pay about $500 million a year in dividends. So if they just repurchased $1.5 billion worth of stock and paid $500 million of dividends, their net cash would increase by more than $1 billion this year. I don't think it's going to happen. I think they're going to buy back more stock, or they're going to find attractive land and then start growing faster than the 8 or 9%, which I talked about earlier. That's a possibility.
And is there any methodology that they use for buying back stock when it comes to thinking about valuation? Is it fairly steady percentage of the market cap that they're buying back, or anything that they use to toggle that decision-making between buybacks, dividends, or investing back into the business via land?
In terms of the timing of share repurchases, early in the year, the building is more capital intensive because they're starting more homes. The spring selling season begins, and they're putting more homes in the ground in February, March, April than they would at other times of the year. Those homes tend to be sold late in the year, and they tend to get heavy cash flows late in the year. So they tend to buy back more stock late in the year than early in the year as an industry. Toll bought back an amazing amount of stock in the fourth quarter of the last year. They said, we simply had the cash. We had a great year, and we bought back the stock. Toll and Pulte are buying back 5, 6, 7% of their stock each year. Horton and Lennar are buying back 2 or 3%. And that is the gap that's crossed my mind. What is Horton and what is Lennar going to do with their cash? And I can't that answer. The answer may be that they may grow faster than the 8 or 9%, that they see opportunities out there to acquire many, many small builders and, in effect, buy their land.
Wind down the conversation with a few miscellaneous questions I had. When it comes to the buyer base, we always think about home building as families looking to purchase homes, oftentimes first time. It seems like there's a shift, or the headline suggests that there's been this shift towards more institutional buyers, where you're seeing the large groups, the large infrastructure funds, real estate funds buying single families that are then converting them into rentals, but maybe more of a shift towards institutional ownership. Is that something that you, one, see, and two, think has a material impact on the business?
It is happening, but to a limited extent. And I'll put it in perspective. Horton probably is the largest builder of homes for rent. That is not included in the 89 and 90,000 houses they're going to sell this year. It's about 10% of their business. So they may sell about 8,000 homes that they built to rent. And those are bought by institutions, heavily hedge funds. Horton is larger than that compared to the other builders. I think it's a very small percentage of the market. It may be 30,000 homes a year are built to rent and therefore will be owned by institutions out of the 660,000 single-family homes that were sold last year. So it's 5%. It serves a purpose because with affordability issue, particularly with mortgage rates going up, if you live in an apartment and you just had a child and you want a home in a good school district and you want a backyard with a barbecue and you want a little pool for your kids and you want a house, but you can't afford the down deposit, you may rent the house as opposed to renting an apartment and get the suburban living style and get a backyard and get in a good school district. So that is happening, but I think it's going to stay fairly limited.
Very interesting. And you segued a bit into my other miscellaneous question, which we've touched on a few different times. But do you have a rule of thumb when thinking about how interest rates, specifically mortgage rates, impact a business like D.R. Horton?
Yeah, they do. Because there are two issues in affordability. One is the price of the house, and the other is mortgage rates. So if mortgage rates climbed higher from here, I think there'd be sticker shock. People that are looking to buy a house and pay today what the mortgage rate is, 6.75, and they might have to pay 9, they would say, oh, let's defer it. Maybe mortgage rates come down. But eventually they have to live somewhere. So again, in the 1980s and 1990s, mortgage rates averaged 10%, and housing demand was fine. And then I want to look at another geography in terms of affordability, California. So where the average house in Alabama might have sold for $200,000 or $300,000, historically, the same house in California might have sold for $1 million. Now, people didn't have 3 or 4 or 5 times the income. So affordability has continued to be an issue in California, yet people live in single-family homes. They adjust their lifestyle otherwise. I think if mortgage rates rise from here, several things will happen. One, people will buy less expensive houses, maybe smaller houses, maybe houses with less content. Number two, home builders have always given incentives to buy a house. So if you come in, well, this house is priced at $375,000, but if you buy it today, Matt, I'm going to throw in this beautiful nylon carpets, which is $15,000 extra, and I'm going to put some marble in the bathroom for you, and that's $10,000. So buy the house today and you get these incentives. When interest rates rose sharply, the incentives changed to with interest rate buy downs. So when interest rates were 8%, they would come to you and say, Matt, I know 8% is a lot for you and your monthly payments are going to be high, but we are going to give you a 6 3/4% mortgage. Now, doing that cost 1% mortgage reduction cost 4% on gross margins. So it reduced the gross margins of the company, but the companies didn't give the other incentives that they normally gave. So it was a trade-off. So I think you could see creative ways. I think other things happen when mortgage rates go up. Many people buying houses today are buying them in their 30s. They used to buy them when they're in their 20s. They have more money because they've been working longer. You now have large wealth in older generations. And in many cases, the older generation, the parents, are helping with the deposit. So the deposit you put down is larger, so your mortgage payments are going to be smaller. So there are mitigations, I think, to higher interest rates if interest rates went up sharply from here. Of course, interest rates today are probably pretty normal at 6.75%. Unless inflation really spiked, I would not think that that's a major risk for the homebuilders.
We close out these conversations trying to focus in on lessons. So when you think about D.R. Horton, maybe even the home builders more broadly, and having spent time looking at this industry, again, going back in time, multiple decades, what are the lessons that stand out from this industry that you think you could potentially apply elsewhere when looking at other industries?
I think the lesson we learned is you have to really step back and analyze a business as to the nature of the business. What do they really do? Not what other people are saying they really do. Not what the analysts are saying. The analysts tend to be very short-term oriented, and I think they have completely underestimated the change of the business. They consider it still a real estate business. It's not. It's a manufacturing business. The ownership of land is incidental. And I don't think they've made that change. So I think in our case, it was understanding that the companies had the wrong model, that they had the model of owning a lot of land and keeping that land on the balance sheet. And once we realized that, it was the process of speaking to the companies and finding out why they owned all the land, what their rationale was, and trying to get them to change their minds. I don't know if our little firm was largely responsible for them changing their minds, but I think we played a role. We do speak to the managements. I know the CEOs of the companies. I've known Stuart Miller from Lennar since the year 2000. That was a year, as I remember, when they bought U.S. Home, which was a stock we owned, and I kidded them that they stole the stock from us. I wasn't happy. They bought the company at such a cheap price that I was unhappy. I would just have preferred to keep the U.S. Home stock. But the lesson is, I think you have to separate yourself from the noise in the street and really sit back and say, what is the nature of the business? What are the fundamentals? How do they make their money? What's the management like? Management's so important. What is the cash flow like? What's in it for the shareholder? Where is the stock priced, and where should it be priced based on the fundamentals of the company?
Excellent. I think there's a really interesting thing there about challenging the conventional wisdom of how a business operates and whether it still needs to operate that way, which you revealed throughout the conversation. So this has been excellent, truly taking us through time, which has been a lot of fun. And thank you for sharing the knowledge.
It's been an absolute pleasure. And I'll end it with one comment to follow up on what you just mentioned. To make money in the stock market, you have to have a differing opinion. If you're swimming with everybody else, it's very hard to make money because stocks tend to discount the fundamentals. So you have to have a differing view, and that's what we have in the home builders, simply that they are worth 16 or 20 times earnings, not the 10 times earnings that Horton's selling at today. And when the market realizes that, I think we're going to be very happy, and I think the shareholders will be very happy.
I love that. What a perfect way to end. Well, thank you very much, Ed.
My pleasure.
To find more episodes of breakdowns ranging from Costco to Visa to Moderna, or to sign up for our weekly summary, check out joincolossus.com. That's JOINCOLOSSUS.com.
A quick note before you go. If you are a company hiring or a candidate looking for your next opportunity, make sure to check out joincolossus.com/recruiting. We launched our recruiting efforts at the end of last year. We started working with firms that were interested in tapping into our audience. And after seeing some early success, we want to open this up to additional firms and to candidates who are proactively looking for their next opportunity. So we are mostly revolving around the investment world and the tech industry. But again, make sure to check out joincolossus.com/recruiting for more information.